next step or the next type of non-current asset that we are going to discuss is investment property. Now, investment property is characterized by two specific intentions of the person who holds the investment property. And what are these? These are either the intention is to earn rental income or the intention is to earn capital appreciation by way of an increase in price. Let's dive deeper into the discussion on investment property. Now, the name itself says investment property, which means we are only talking about land and building here, no other asset. Property, that is land and building held by the owner or by the lessee as a right to use asset to earn rentals or for capital appreciation or both. Rentals or for capital appreciation or both. Now, in financial reporting, there is one word that, or there are other two words that are used fairly frequently, and which are these? One of these is intention, the other one is expectation. When I say that I have an intention to hold non-current assets for the purpose of earning rentals, in a lot of ways, when we are preparing financial statements, we'll have to understand with what objective is this particular non-current asset acquired. Is this building acquired so that I can continue to conduct my operations from this building, or is this building acquired with an intention to give it out on rental to someone? So that will help us to understand the classification of non-current assets. So basically, investment property, land and building, these are assets not used in the ordinary course of business to produce goods or to provide services. Now, if if I have purchased a building and I'm conducting my operations from there, or if I have a factory in which production is happening, that means that factory is being used for the purpose of producing goods or services. That does not get classified as investment property. If I have purchased, say for example, I live or I conduct my business operations out of one location in Noida, and I have a couple of other properties, one in Gurgaon, one in Delhi, one in Mumbai, one in Agra, somewhere else. And the only intention of holding these properties is to give those out on rent to someone, then those will get classified under investment property. Examples could be land held for capital appreciation. There are so many people out there, I'm sure somebody in your family or friend circle have done it, that they purchase a plot of land. You know, like there's a new airport coming up near Noida, or there is a new airport coming up in Navi Mumbai. So the idea is that purchase a piece of land there right now. Then the area gets developed and the property prices rise, sell off the land and make money in that process. Or land held for undecided future use is also investment property, as are buildings leased out under an operating lease. What are operating leases? Operating leases are those lease agreements where the ownership of the asset does not pass on to the owner. The ownership of the asset does not pass on to the tenant or the lessee at the end of the lease term. More on this when we study IFRS 16 a little later. Now, there are a list of items or a couple of items that can ideally never be classified as investment property. Which are these? The first one is asset or property held for use in the ordinary course of business to be used in the production of goods or supply of services. So this property in Noida, from where we are conducting our business operations, we are delivering so many batches, conducting so many lectures. This premises is used for rendering services. This is not investment property. A business entity operates out of a particular premises where production is happening, then that is also not investment property. Property held for sale in the ordinary course of business or in the process of construction or development for such sale. Now, whenever we talk of inventory, the idea is that these are items which have been acquired with an intention to resell. Now, these are not acquired for current use also. These are not acquired with a long-term perspective of earning rentals. The objective is to acquire properties with an intention to resell them. So properties which are in the process of construction or development for such sale, all of these are classified as inventory. They cannot be classified as investment property. Then owner occupied property. We are say for example, someone like a JSW Steel or JSW Ports, they have their ports on the coastal areas, but they could have a head office from which production or supply of services is not happening, but it is the primary head office in which the corporate division or HR or all of these people sit out and operate. That is basically owner occupied property, property occupied by the owner, not necessarily to be used in production of goods or supply of services, but property occupied by the owner is also investment property. Then property leased out on finance lease. Uh, Property leased out on finance lease is, what is a finance lease? A finance lease is a leasing arrangement in which the ownership of the property passes on to the tenant or the lessee towards the end of the useful term. Again, we learn more about that under IFRS 16, but that also is not an investment property and property being constructed or developed on behalf of others. If I'm into the business of construction, I'm constructing houses, I'm constructing commercial premises, and these are semi-finished or work in progress premises. Still, these are also not classified as investment property. So I prefer learning instead of keeping in mind what all comes under investment property, because that could be a very wide field. I would prefer remembering or paying attention to what all items can never be investment property, and then those items are we have a list of those items. The best way to master this concept is to learn the 5 or 6 items here. Okay, now investment property is initially measured at cost. So when I purchase, say for example, a building which I intend to give out on rent, I pay 1 crore for the purchase of that building. It will be measured at cost. After recognition and initial measure, so say for example, on 1st of Jan, I purchased an investment property for 1 crore, and on 31st of March, I have my financial year end. So my question is, on 31st of March, will you let the investment property remain at 1 crore, which is its historical purchase cost, or will you bring up its value to its fair value on 31st of March? Now, IAS 40 offers you a choice. What is that choice? IAS 40 specifically says that either you can use the cost model, which is the historical cost model, or you could use the fair value model or the revaluation model. Now, that depends upon uh, basically the business entity's overall operations and its specific circumstances. The idea in financial reporting is that whatever items you show in the financial statements, be it P&L, be it balance sheet, they should reflect the economic reality of the balances and transactions. Okay, now the first model, which is your cost model, a historical cost model, which you have seen in so many other accounting standards also. Here, the investment property is shown at cost less accumulated depreciation. Revaluation is not permitted naturally. That is not the model you have chosen. But you could also use the fair value model, which in a lot of ways for investment property would be the more appropriate model. So whenever there is a change in fair value of investment property, the change gets recorded through P&L account, and the moment you start using the fair value model for investment property, then no depreciation is charged. The idea is, see, any increase or decrease in the value of that particular asset. Okay, any increase or decrease in the value of that particular asset is taken care of through the fair value change, and that fair value change is automatically getting routed through P&L. So if the fair value change is getting routed through P&L, then there is no need to record depreciation separately. The depreciation, what is depreciation? Depreciation is a systematic reduction in the value of an asset. Here, in case of investment property, any change in fair value is automatically getting recorded through P&L, so no need to record depreciation all over again. And any fall in value is taken care of by way of revaluation, which means no need to record depreciation separately. Now, with that in mind, see, there's a difference. When you look at IAS 16, okay, when you look at IAS 16, If you are using the fair value model or the revaluation model, the change in fair value gets routed through revaluation surplus OCI. Here, the change in fair value gets routed through the profit and loss account. So that is a major difference between the two. Now, there could be a situation where the business entity has acquired a particular property for use in its regular course of business. Maybe it is owner occupied property, and later, for because of change in circumstances, the same property, plant and equipment, there is a need to reclassify that as investment property. Let us look at a situation. Okay, asset is transferred from PPE to investment property, and fair value model is used for investment property. Pay attention. I have written a detailed explanation, which of course, you can always refer. The notes will be with you. Say we have an office here in Noida, and this is the office, this is the building from which we conduct our business operations. Since this is owner occupied property, it has been classified as property, plant and equipment. Now, as our operations grow, as we become a bigger company, we find this office space inadequate. We need a bigger space to accommodate more staff members, to accommodate more people. So what we do is we find out another building, we acquire that building and shift our operations there. But the owners, the directors of the company feel that this particular building, we don't want to sell it off. We would want to keep on earning passive rental income from this. So while we shift our operations to another building, this particular building where we are staying, where we are operating out of right now, we don't sell it off, we give it on rent to someone. So till the time we were occupying this particular building, it was property, plant and equipment. But now that we have rented this property out to someone else and we are earning rental income, now this particular property has become investment property. So you see, this particular building earlier when it was acquired, it had to be classified as property, plant and equipment. And now when the classification, and now when we are leaving, vacating this premises and giving it on rent to someone else, then this property becomes investment property. This is the kind of transition we are talking about, and the fair value model is being used for investment property. The company uses fair value model for investment property. In this case, there is a rule in this kind of a situation that we have to follow. You should revalue first according to the old classification, and then you should reclassify. So earlier it was property, plant and equipment. When you decided to change the usage from property, plant and equipment to investment property, till that date it was an item of PPE. Say for example, I purchased this property for 100 crores, and now the value has gone up from 100 crores to 120 crores. When the classification changed on say 31st of March 2025. But the increase in fair value, when did the increase in fair value happen? The increase in fair value from 100 crores to 120 crores happened when this property was an item of property, plant and equipment. Okay. And the classification changed on 31st of March, and then it became investment property. So just date ko you did the reclassification. Till that date, it was property, plant and equipment. The increase in value happened during that period when it was PPE. So you should revalue first. So revaluation should happen as per the rule for PPE. First, revalue the asset as per IAS 16, transfer the gain to revaluation surplus, then transfer the asset to investment property. Whatever is the past depreciation recorded in earlier years, that remains, and post change to investment property, there will be no more depreciation. Okay, because when you use fair value model for investment property, there is no depreciation. Okay. And how do you show it in the balance sheet? Before the change of classification, property, plant and equipment was 1 lakh, investment property was 0. After the classification underwent a change, first of all, what you did was you recorded an accounting entry for revaluation, which went somehow like office building account debit to revaluation surplus. In the balance sheet on the liability side, you are now showing revaluation surplus of 20, and on the asset side, PPE, property, plant and equipment is 0. Investment property is now 1,20,000. 1 lakh plus 20, that is 1,20,000. Okay, so all that has happened is instead of remaining classified as 1 lakh, it now gets reclassified as 1,20,000. And of course, the value has changed, but earlier it was shown as property, plant, and equipment. Now in the balance sheet, you are showing it as investment property. So what is the rule? Revalue first as per the old classification and then reclassify. That is that is the first situation. The second situation is asset is transferred from property, plant, and equipment to investment property, but you are using the cost model for investment property. So here the approach is even simpler because there is no revaluation happening for investment property. Asset gets transferred at the current carrying amount, continue to depreciate. Only the head changes. Earlier in the balance sheet, this particular building was shown in property, plant, and equipment. Now, after the change of classification, this building is shown in investment property at 1 lakh. It's only the heading which changes, nothing else undergoes a change. So when cost model is being applied for investment property, your life is rather simple. Just change the heading and your job is done. Now, second case, see, the first type of transfer was from property, plant, and equipment. You went to the classification of investment property. The second situation is you are going from investment property to property, plant, and equipment. So, the just go back to the story that I told you first. We have a building in Noida in Sector 3 where we are conducting our operations. This is property, plant, and equipment. We felt that okay, we are growing, we are expanding. This building is not enough for us. So we shifted to a new building. When we shifted to the new building, we did not sell the old one, we gave it out on rent to someone. So it became investment property. That was the first part of the narration. Now, our operations have grown even further, and now we feel we can make one entire team sit in the old office and one entire team in the new office. So we can, this old property which we had started giving out on rent, we cancel the agreement and we shift one team to this building. So now it has again gone from investment property to property, plant, and equipment. So, what is the situation? Asset is transferred from investment property to property, plant, and equipment, and fair value model is being used for investment property. In this case, revalue first and transfer the gain to P&L account. Okay, then transfer the, so revaluation should happen first as per the current classification, which is investment property. So revalue first, transfer the gain to profit and loss account, and after you have done this revaluation, then transfer the asset to property, plant, and equipment at that fair value. Then depreciate as per accounting policy year on year, because for property, plant, and equipment, depreciation is inevitable. Okay, case 2 is asset is transferred from investment property to PPE and cost model is being used. You have to do absolutely nothing. Asset gets transferred at the current carrying amount and you continue to depreciate the asset. The rule is revalue first as per the old classification. Revalue first as per current classification. Then reclassify later. This is a tip that you will keep in mind for all. This table here in a way summarizes what we have discussed. When you are going from investment property to PPE, step 1, revalue, gain goes to P&L. Step 2, change classification. Step 3, PPE gets depreciated. If you are going from PPE to investment property and fair value model is used for investment property, revalue, gain goes to revaluation surplus OCI. Then change the classification. Then, of course, you realize the fact that investment property under the fair value model does not get depreciated. And the easier situation is, or rather the situation which requires less steps. There's nothing easy or difficult about it. When cost model is used for investment property, you are going, whether you are going from investment property to PPE or PPE to investment property, all you have to do is you have to change the classification and then you continue to depreciate. This sheet is a smaller one. Okay, one more point I would insert here and then the other sheet we can do away with. You should always check what valuation model is used for investment property. Okay. the model that is used for PPE is not relevant. So just have a look at it. And now after this, we will be attempting a couple of questions on investment property.